Before we begin, please let me remind you that during the course of this conference call, Valens management may make forward-looking statements. These forward-looking statements are based on current expectations that are subject to a number of risks and uncertainties that may cause actual results to differ materially from expectations. For more information on the company's risks related to these forward-looking statements, please consult the company's MD&A and other regulatory filings available at www.sedar.com. Any forward-looking statements should be considered in light of these factors. Please also note, as a safe harbor, any outlook we present as of today, and management does not undertake any obligation to revise any forward-looking statements in the future. Joining me on the call today are Mr. Tyler Robson, Executive Officer, Mr. Chris Bison, Chief Financial Officer, and Mr. Jeff Fowles, President. With that, I would now like to hand over the call to Tyler. Tyler.
Thank you, Everett, and welcome to everyone who has joined us for our fourth quarter and year-end November 30th, 2019 conference call. If I compare where we are now to where we were at the start of fiscal 2019, the difference is vast. At the beginning of the year, we were primarily an R&D company, building out a diversified extraction platform and a number of testing methodologies with no meaningful revenue. 12 months later, in the fourth quarter of 2019, we have become the most profitable publicly traded company, cannabis company in North America, excluding fair value adjustments and one-time items. We were able to achieve this phenomenal growth by securing and executing on multi-year extraction contracts with leading players in the cannabis sector, which positioned us as a partner of choice in the industry. In the second half of 2019, in preparation for Cannabis 2.0, we broadened our platform beyond the extraction to include white label product development and manufacturing. We now produce a broad portfolio of safe, consistent, innovative products to both licensed producers and unlicensed companies, such as brand-focused entities and consumer packaged goods companies who help differentiate themselves and build their brands in the cannabis market. High purity distillates and Cannabis 2.0 ingestion oil-based products contributed to the record revenue in the fourth quarter of 2019. We leveraged cross-selling opportunities with key extraction customers to launch new products and broaden their product portfolio. We are also rapidly securing and increasing a number of white label contracts with new customers, which Jeff will elaborate on later in today's call. We are currently the most diversified large extraction and product development and manufacturing company in Canada. And with the capacity to manufacture more than 25,000 kilos of distillate and a broad portfolio of generation oil-based products. To ensure we have the capacity and flexibility to handle continued acceleration in demand for our products, as well as handle seasonal variations in demand, we are expanding our 425,000 kilogram extraction input to over 1 million kilograms and adding significant scale to a number of our manufacturing capabilities in the second half of 2020 once our expansion in Kelowna comes online. We believe our multi-year contract manufacturing platform, proprietary technologies, and advanced product capabilities uniquely position Valens in the cannabis market and provide sustainable competitive advantage through which we will continue to service our customers and generate shareholder value. In the fourth quarter, we generated record revenue of $30.6 million. This represents an 86% increase over the third quarter and a 240% increase over the second quarter of 2019. This increase was given our extraction activities as well as the Cannabis 2.0 definite product sales. Gross profit for the quarter increased to $20.6 million, or 73.8% of revenue, compared to $12.6 million, or 77.8% of revenue for the third quarter of 2019. Adjusted EBITDA was $17.7 million, or 57.7% of revenue, compared to adjusted EBITDA of $9.8 million, or 59.4% of revenue for the third quarter. While we continue to expect strong margins throughout 2020, we expect some margins to moderate over the coming quarters as white label products introduced become an increasing percentage of our revenue. As discussed in our Q3 conference call, while these products generate more significant margins, they represent a key strategic shift in our business, allowing us to be one-stop shop with customers to further integrate ourselves into their value. Finally, net income in the quarter was $4.5 million, before 2.6 net income margin, making it the most profitable publicly traded cannabis company in North America, with the highest net income resulted in reduced volume. It allowed us to expand our agreements with a number of customers to process white label products and increase the revenue per gram of input to $1.25 per gram in the fourth quarter of 2019, 61 cents per gram in the third quarter. Revenue per gram is expected to increase further in 2020 as product development contracts continue to grow in number and contribute to a higher proportion of total revenue. The number of white label product development contracts we have signed continues to ramp significantly and now outnumber injection-only contracts. This supports overwhelming demand for white label product development and manufacturing services. In December, we entered into a multi-year manufacturing agreement with a Health Canada licensed party that provides us with additional license capacity. An initial 5,000 square feet has been allocated to VALENS operation, with a total of up to 50,000 square feet made available, subject to counterparty receiving the required Health Canada license amendment. On our last quarterly call, we discussed some of our agreements we signed in Q4, including major contracts with Iconic Brewing and Shoppers Drug Mart. Since then, we have continued to see customers, including our largest publicly announced multi-year white label agreement to date for a branded finished product with Burns Limited. Burns is a leading premium cannabis distillery company, which has shown impressive sales growth. They approached us to launch a line of unique, high-quality cannabis vape pens in Canada with a minimum of 2.2 million vape pens to be produced over an initial 2-year term. We believe this represents gross revenue potential to VALENS of over $50 million in the first 2 years, subject to final acceptance from the provincial distributors, including acceptance of the proposed price per unit. We expect to get our first shipment for Burns in the first half of 2020, and are delighted to be collaborating with them to bring to market a line of differentiated vape products for Canadian consumers. Since the year end, we secured a number of new contracts, including a multi-year distillate and source malt supply agreement with Finalio, which is a large-scale edibles producer. Finalio has been active in the Canadian cannabis sector for many years, advocating for safe, high-quality edibles for the adult use market. They are rapidly scaling their operations with a purpose-built, state-of-the-art, large-scale facility coming online in 2020, which will give Finalio the capacity to produce more than 400 million units in the first year of operation. They're delighted to be partnering with them at this exciting point in their growth. In December, we also announced a multi-year extraction and white label agreement with Emerald Health Therapeutics. We have already started formulating, mixing, and filling products for Emerald Health in preparation for vaporizers, soft gels, and tinctures. As our customers continue to roll out products in Canada for Cannabis 2.0, and the size of the market expands, we expect to secure more sales opportunities that are even larger in size and encompass a broader array of products. We are excited about the opportunities not just in Canada, where we expect demand for our services to continue to accelerate, but also globally as international markets open up. We are confident we can leverage our expertise to be a pioneer in the global cannabis market as it moves into legalization. In February 2020, we achieved a milestone when we announced our first international purchase order for the shipment of white label products to customers in Australia. We expect to receive the tinctures totaling 3,000 units starting in Q2 2020, pending receipt of necessary import and export permits. We believe Australia's strong underlying demand for cannabis products, together with the continued adoption of medical cannabis laws and potential relaxation of CBD laws, will drive sustained growth in the Australian market and continue to extend our footprint in Australia as well as other international markets as they open up. To further prepare for this, we expanded our exclusive license for storage cannabis emulsion technology to include Europe, Australia, and Mexico, in addition to Canada, representing a nearly 20 times increase in the addressable population. This access to international markets in the near term is a unique differentiator for VALENS and bolsters our white label product offering. Consideration for the exclusivity and the expanded geography was $10 million US, consisting of $6 million in cash and $4 million in common shares. The agreement carries an initial 5-year exclusive term, with a 2-year renewal of the exclusivity subject to certain performance milestones related to operational and financial achievements. As part of the agreement, VALENS will transfer the source royalty payments, which are subject to an annual minimum of $2 million over the term. While we are committed to global expansion, capital expenditures will be mainly focused in Canada with a view to exporting products to medical markets that have limited distribution. We aim to responsibly manage our growth to build a sustainable business over the long term so we can truly maximize the opportunity inherent in the global cannabis market. As international markets mature, we are on the lookout for acquisition and other opportunities that provide us with an accelerated platform to gain market share. I look forward to providing further updates on our international strategy as 2020 progresses. With that, I'll now turn the call back to Everett Knight to talk about some of our corporate and capital markets development. Everett, please go ahead.
long way in a relatively short space of time. As we enter the next phase of our growth, driven by our extensive white label product development and manufacturing capabilities, together with the rising demand for 2.0 products, we are cognizant of the need for shareholders at the heart of all of our decisions.
That's right. Me, number one.
Always have the strongest foundation to navigate our growth with the emerging cannabis market. In December, the Sector Exchange approved the normal course issuer bid, otherwise known as EST, to acquire up to 6,275,240 VALENS shares over the next 12 months, which, if utilized, will be funded with cash on hand. Given our strong financial and operational performance, prevailing market conditions, and the value of our shares, we are pleased to have the NCIB in place at this time. We're also pleased that our operational accomplishments continue to be recognized by the investment community, and we have been included in the recently introduced S&P TSX Cannabis Index XCAN, which is comprised of a select group of cannabis issuers trading on the TSX Venture Exchange. Our shares are also now PST eligible in the U.S., which should provide increased visibility and accessibility for our shareholders moving into fiscal 2020 and allow us to reach new investors in larger markets. We expect to continue to analyze different exchange opportunities in the near term to access more liquidity for our shareholders. We are still seeing a significant supply of flower on the market, and the launch of Cannabis 2.0 products in Canada has been met with strong initial customer demand. These fundamental market dynamics are expected to drive demand for our services throughout 2020 and beyond. We believe the product offering with consistent, high quality, and predictable user experience will capture the most market share and empower brand development in a strict regulatory environment. We are proud to have been entrusted by several leading brands to produce white label products, and we are currently formulating and manufacturing 19 SKUs over 3 different 2.0 product lines. To meet demand for our customers in 2020, we will continue to invest in developing the intellectual properties that will define tomorrow's cannabis market across a range of products, including vape pens, edibles, concentrates, cannabis-infused beverages, topical, tinctures, and capsules. Our focus on innovation and ability to provide a broad range of services throughout the supply chain, including customized formulation, emulsion, and terpene enhancement, uniquely positions us to service a wide range of customers. We believe that innovation and focus on consistency led us to have what we consider to be the highest quality API of distillate, isolate, and other custom formulations on the market. This diversification strategy in our white label business is also enabling us to build a broad IP portfolio for product development that spans all products from tinctures and beverages edibles to topicals and concentrates. During the fourth quarter, to accelerate our commercial scale entry into the high growth beverages and edibles market, we acquired Tommy's Cider Co. for $7.6 million. Tommy's is a leading Ontario-based beverage company and mature cannabis microprocessing application. Initially, we intend to leverage the beverage manufacturing infrastructure of the Tommy's facility and the know-how of its founders to capitalize on cannabis-infused beverage white labeling opportunities, including our existing agreement with the cannabis division of Iconic Brewing and other potential partners. We are already producing beverages in Western Canada that should be on the shelves in the next few months, but look to increase current capacity once the Tommy's facility is online. To ensure we retain our leadership position in this market as it matures, we are budgeting for approximately $10 million of capital expenditures at the facility over the next 12 months, following which Valens expects to have a significant capacity for beverage, edible, and source emulsion formulation in Greater Toronto area. The planned capital expenditures to bring the facility into full operation are fully funded with cash on hand. With that, I will now turn the call over to Chris Biden, CFO, to talk about our financial results.
Based on the operational achievements highlighted earlier in this call, consolidated revenue is $15.1 million for the fiscal year ended wages, and advertising and promotion expenses as the company scaled its operations to meet demand for services in 2019. Adjusted EBITDA was $27.4 million for fiscal 2019. For the fourth quarter of 2019, adjusted EBITDA was $17.7 million, or 57.7% of revenue, compared to adjusted EBITDA of $9.8 million, or 59.4% of revenue in the third quarter. The company recorded a tax provision in the fourth quarter of 2019 of $6.3 million. With the wrap-up of profitability through fiscal 2019, one of the company's entities became taxable in the fourth quarter after using up all available non-capital loss carryforwards. The company has strategies in place to effectively manage the overall tax structure of the company and review this tax structure on an ongoing basis. The company posted a net loss in the year of $6.5 million, compared with a net loss of $15.9 million in the same period in 2006. For the fourth quarter, the company reported net income of $4.5 million. The company had $58.7 million in cash and short-term investments as of November 30th, 2019, compared with $25.2 million as of November 30th, 2018. The increase is due to the closing of April 2019 bond deal financing for net proceeds of $40.3 million, the exercise of warrants for gross proceeds. Funds will primarily be used by the company to keep the growth strategy, also for risk and working capital purposes. With that, I will now turn the call over to the operator to open the line for the Q&A.
Hi, good morning. Congrats on the quarter, guys, and thanks for taking my question here. A few questions I wanted to get through. First is, you mentioned the base initial returns, I believe in H1 2020. Can you maybe comment a little bit on some of your other derivative or legalization 2.0 products, in beverages in particular? When do you expect those to hit the shelf in Canada?
Yeah, sure, David. Thanks. So obviously a number of these types of SKUs available, picture SKUs, in beverages. We just received recently PO from the province of Ontario for beverages, so we expect to see those iconic beverages on the shelf within the next couple of weeks.
Ooh.
Okay, and the first beverages?
Yeah, so the iconic beverages are source-based beverages.
Thank you. Moving on to vapes, and I think everybody in this industry is well familiar and caught up with some of the controversies around vapes over the last several months. I'm just wondering now, in Canada in particular, especially with Alberta opening up and getting rid of that ban, how has your business been impacted with the controversy with the vapes, and now with a lot of it seemingly going away?
In the short term, we didn't really experience any major challenges with negative news debate. It's always been our position from a Canadian context that the labeling and the content requirements would allow us to provide safe and consistent products to the Canadian consumer. So in the short term, we didn't notice any material changes. What it may have done was spell some of the longer term growth, but in the back of Alberta changing course and there being a number of SKUs in the market that are continuing to sell well, we do now have longer term opportunities and quite strong growth. David, just on that note, never used. I think we can see growth in that marketplace and the initial demand has been good for customers as well as their consumers overall. And from our standpoint, with our turkey formulation, we differentiate ourselves from that, and we get more formulation and custom formulation for our customers with our unique capabilities. I think we have a very unique opportunity.
question here, and then I'll hop back into the queue. Looking at CapEx here, and what, within your perspective, for 2019 is a little light, actual versus guided. Can you maybe just give us some guidance for CapEx for 2020?
Yeah, David, this is Jeffrey. So, it is the MPA kind of feature that we put in there. So, the CapEx really for our we have our current facility K1, but it's kind of the first half of 2020 years fully built, and then ramping up into the back half of 2020. So that's spending there, call it 20 million left, and we're also spending $10 million on the pump facility to build that out to get ready for edible service.
And that will also be in H1 2020?
No, obviously will be end of 2020, beginning of 2021, just depending on whether we both like edible and beverages at once. We can do. We're still deciding whether we get one up sooner or use both at once. So that's still evaluating that opportunity. We'll keep the market up to date with that program. That is known.
But the CapEx will be spent over the course of the year.
Okay. Thanks, guys. I'm going to jump back into the queue. Again, congrats on the quarter.
Next question.
What is actually recorded that? About your receivables balance and income back on time, and how do you go about selecting the partners that you work with and ensuring that they have the capacity to make?
Chris, do you want to touch on this one?
For sure. Yeah, so we definitely are kind of actively managing our relationships with all of our partners. To date, we haven't had any issues with flexibility. I think, as you noted in our MPG, we had at the end of the year about $7 million over 60 days. As of this point in time, there's about 300,000 of that that still remains outstanding or hasn't been offset against payables with the same vendor. And we're confident that those amounts all remain collectible. I guess from a process standpoint, to answer the other half of your question, we definitely, as we're kind of engaging in the relationships we have with our partners, we do a lot of due diligence on the front end, making sure that we're comfortable with who we're investing credit to through those relationships.
And just to further that comment, like as far as our customer base, is a very diverse customer group, and going into 2020, we forecast every customer being under 20% of our revenue. If you look at that, most will be under 10%, and I think you see that customer base continue to expand, increasingly impacting one customer versus any one customer.
Thank you. And in terms of, could you elaborate a little bit more on kind of the white label contract that's really in the pipeline? At what point do you think you can see the details of these contracts and how you control revenue?
I think you're going to start to see those white label contracts, the red layer contracts, with products to shelf very soon in the coming year. And as we move into the back half of the year, into Q4, we expect that those revenues and coming from those contracts, we expect to outpace the number of bases with the extraction only contracts.
And just because of kind of the growth profit this quarter, 74%, that's very healthy if I compare to the second quarter, considering that was kind of a one-time opportunity that's margin. Is it right to kind of think about growth margins, pretty healthy growth margins this quarter as a result of your white label manufacturing, and therefore this white label would continue to kind of be expecting similarly healthy growth margins at some point in 2020?
I think as we look at the gross margin profile, as we're moving into more and more white label, I see it's probably the opposite. As we said in some of the commentary, is that the margin profile that we're going to experience, we believe, will moderate over the next couple of quarters here. That the overall EBITDA profile from white label contracts, we get more aggregate value per gram of input, but the margin profile is smaller. So I think you're going to see that our margin near term, and obviously the revenue per gram would probably be a lot of that based on how that's been. From that perspective.
Yeah. More what you should look at, John, in that regard is more finished product. For every finished product you sell, the revenue per gram is a lot higher. So on your comment stress on base extraction, that on the per gram of input basis, our extraction numbers are lower, but in fact, the same extracted oil goes into a finished product, that revenue per gram increases.
Okay. And then secondly, then, when I look at your components, your raw material inventory is $7 billion. So can I assume that maybe stockpiling some pretty cheap biomass from the quarter that you haven't received yet, and presumably that can actually help provide a bit of a boost for
So I don't think I'd use the word stockpile. If you would advise, please jump in if you want here. More I would say is that we get opportunities from time to time to get some strongly priced or well-priced products. We don't speculate, we don't take positions, but if we have white label contracts that we have to fulfill later on the year, we will be opportunistic and access those buying when they're available.
Okay, perfect. Maybe just talk about just prices in general, what you're seeing out there, seeing prices coming off, heard about extraction rates coming down, and there's been a dispute, obviously, in the industry. So where are you seeing things? Are some of the white label prices starting to come down from where you were negotiating maybe what you got 6 months ago, and just trying to give us a sense direction where some of these things are going?
Hey, John, Dever here. We've actually seen the opposite of white label pricing increasing. You got to remember this is the beginning that currently you're negotiating with the distributors. So once that price is set, we have good visibility on that front. The good news from a margin standpoint is that as dry cannabis prices continue to go down, we can increase our overall margin because we have the visibility on the end market, and that just goes straight to the bottom line.
You're seeing a double whammy, that you're seeing the white label prices increases, and you also see a benefit from the dry cannabis flower increasing. That's right.
Yeah, I think as the market matures, you're going to start to see a different quality of products and many different levels of pricing. So we're starting to see some of that maturity come into the market in terms of higher quality and getting higher pricing. But absolutely, once the pricing is set in the provincial distribution area, if the input pricing goes down, then that increases margin.
Okay, thank you. I'll get back. Next question.
Thanks, guys, and great quarter. Yeah, so just with the Q4 results, can you provide any color on the volume mix in the quarter, along with the pricing, whether you saw certain areas strengthen or come down versus what you guided to last quarter?
So from a volume standpoint, some more cannabis going into kind of the 2.0 products. Obviously, everyone's getting ready to put vape pens and edibles in the marketplace, which means they have to prepare and get obviously oil-based products and oil in general to the market. So our mix was really driven towards that white label, and as you mentioned previously in the call, Jim, I think you see that continue to expand rapidly, especially with some of these new products coming here on the shelf.
You're not willing to maybe give specific volumes on that?
We're not disclosing specific volumes right now, but as we get more transparency on the mix of our white label, we'll be giving more and more information to stakeholders, obviously. It's just we don't have that mix because we still need to use going and expanding every day. We just want to have the ability to do that.
Got it. Okay. Well, maybe more just a general question on the 2.0 rollout and what you're seeing on your end. Differences across the provinces or products. Yeah, just your thoughts on how the rollout is going in general. supply side?
pretty different across the board.
Okay.
Pretty standard across the board.
And in terms of supply,
From a dry cannabis standpoint,
no, on the 2.0.
I think what you're seeing is there's only really over 10 sophisticated licensed producers with products on the shelf, and obviously people are having trouble with it keeping up with the demand today. It depends on which SKU, but I think you see that continue to be going forward.
Thanks for answering my question, guys.
Guys, just a couple of questions. I was just wondering how white label revenue is going to sort of trend in the first half and then the second half of the year, sort of the revenue split, or what do you think it could be?
Yeah, so I think you can see as the quarters evolve here that white label percentage of revenue increases to the point when we get into the back half of the year that we believe that white label revenue will overtake sort of basic extraction revenue. So in terms of overall mix for the year, hard to say at this point exactly how quickly that white label accelerates other than that general trend. But likely, the majority of the 50% of our revenue for the year will likely still come from basic extraction.
Great. And then looking at 2021, I know it's a little bit off, but do you think it could be 50-50?
I think going into 2021, it could be actually more skewed towards white label.
Great. And just to, what we've seen in the industry is, there's a lot of companies or a lot of LPs out there who have capital, sort of they're constrained on a capital side, and a lot of them have sort of indicated that they have wanted to move into extraction and do some self-extraction. Are you finding that, now what we're seeing is companies not necessarily wanting to invest in basic extraction, so that means potentially more business for you?
Yeah, Greg, that's exactly what we're seeing. So as everyone knows, cash is king. With a lot of these LPs, cash is a little bit higher. We're definitely seeing the demand growing, and we'll see contracts coming forward in the foreseeable future. But yeah, we have absolutely no issues filling our pipeline. Demand is getting. One of the biggest things too is our hydrocarbon. We're one of the only ones to offer any third-party hydrocarbon products, so that's very highly sought after, which will be in the foreseeable future as well.
Great. How big a lead do you think you have on hydrocarbon over the next year, Sky? Like, if I wanted to try to get licensed for hydrocarbon, how long is it going to take?
So it took us 2 years to get up and running, right? And obviously you need reinforced concrete, you need fire suppression systems for anyone else getting it. So is it that long for another person? No, I don't think so. I think it's faster. But a lot of our customers, the feedback we're getting from them is saying, hey, we're in a residential neighborhood and we can't even get stones. And we actually don't want to put a bomb-proof roof in our $100 million facility. So I think we have a longer route there.
One final question. What is sort of your pipeline for bringing on additional white label customers? It sort of leads into the first question I had. People are capital constrained. They don't want to build their own facilities. You guys have capital and you're building out capacity. So what's the ability for you guys to continue to add large-scale white label guys?
I think the opportunity is endless, Greg. What you'll see in the foreseeable future is us actually diversifying our customer base and moving away from some of our licensed producer partners and more going after the CPG relationships where people are still dabbling their toes in the water essentially with what they're thinking. So they see unique value adds that they can come to us and basically test the water to get the data, launch a few SKUs under a different brand, and then really you'll see even more CPG relationships coming out of VALENS shortly.
Okay, so further to that point,
because of the white label coming online, which technically is a lower margin business for you, but you're really only operating at around 25% utilization, 25,000 kilograms processed, which is at an annualized run rate of 1.5. So how do you reach a higher utilization rate going forward in terms of how you streamline the business, economies of scale and whatnot, and help drive the margins versus some of the offsets with the white label customers? Look at that going forward.
Well, the two of them are not necessarily apart, John. So it's all about downtime, right? So if we're doing a lot of small lot runs, our actual capacity, if we were operating that for a long period of time, would be 425,000 kilograms. Right? That's an average number based on average processing size and downtime. So the smaller the lots, the more the downtime, the less capacity we actually have. So as you are continuing to get large volume runs from base extraction, that efficiency goes up, but also as we get larger product runs for our white label products. So instead of getting runs of 100,000 base cents, we get runs of 1 million base cents or 2 million base cents, et cetera. That really changes the efficiencies under which we can operate. So it's not necessarily just extraction versus white label.
Is it fair to say that for at least the next several quarters, as all these customers are trying to ramp up and introduce various products, and then like testing product sales and see if we're more to that one work, we're probably going to see a lot more smaller runs still, and then again, a better handle on what works for them, upon which then they'll start coming out with the bigger runs. So we're still going to have that as a bit of a headwind to smaller runs.
Well, I think there's going to be a nice mix because a lot of the smaller lot runs that we did go very well in the market, and they're really starting to, the scale of the orders that we're getting are increasing on those items. So you're going to have that happening while we're introducing a bunch of new brands and new companies and products under the market. So they will be smaller lot runs, but you're still going to have the base extraction large runs and large growth from LPs in terms of the flower production continues to come off out of the production facility.
And you're even seeing that on our staffing too. And even just the other day, we had a job fair program. We're just seeing that demand. We're increasing the shift amount. And we're preparing for that right now.
I think also the question on the white label pipeline. What percent of our players that you're talking to in the pipeline starting to represent more than the traditional LPs, or how's that pipeline thing looking from a traditional versus customer?
Well, it's so hard to say, John, because in terms of actual volume from some of these CPG players, obviously they hold their cards close to the chest in a lot of cases, and we're continuing to work through discussions with them. So pretty hard for us to say at this point. But what I can say is that the volume from that group will be expected to continue to accelerate, as will the number of parties in that group.
Right. So I think in some of your previous decks you had talking to 50 different potential white label customers. That's also where I'm getting to. For example, how many of those are more mainstream versus just LPs that are looking to have a white label product?
Oh, I see. So you call them LPs, so I wouldn't call them LPs. There's a lot of non-licensed parties in that system, right? So CPG companies, to me, I'm thinking of the large multinational, international companies when you say CPG, but there's a lot of branded companies that have limited product portfolio that are well positioned in their market. We have a lot of those conversations with.
Thank you. Thanks, guys. So I just wanted to go back to talk about international a bit. I mean, you guys put out a really nice announcement, I guess, last week or a couple weeks ago regarding the Australian deal you have in place there for medical cannabis. Just want to touch on how you see your strategy overall from international. Are we still looking at having an EU GMP type model from your Kelowna facility and exporting that, whether that's Europe, Australia, etc., or are there still ongoing opportunities that you're assessing on an international basis with having some sort of physical presence?
that facility. That just makes sense. But at the same time, we have a number of ongoing conversations in international markets where we have the right partners and the right distribution opportunities, the right assets. There's transactions that we would look to do there as well. So we're really looking at it from a global infrastructure and efficiency perspective as opposed to just market by market review. So if we can service out of Kelowna and drive volumes out of there and get efficiencies, we will. If there's other opportunities in markets, we're not afraid to transact there. But whatever we do, to be clear, there's no big swings in our future. We're not going to, take a big swing at a large scale acquisition or something. The market opportunities are good, but they're small and they're growing. So a right size facility with the right amount of capital allocation is the way to play it.
Thanks very much.
Operator, fiscal 2019 was pivotal for VALENS. We established ourselves as a go-to partner in the industry, provided our ability to execute on extraction contracts and high-quality white-label products to support our customers' brands. Previously, VALENS was best known as a leader in extraction, but with product development and manufacturing contracts now outnumbering extraction-only contracts, here we are much more than that. Our rebranding as the VALENS company reflects the company's evolution and expertise from extraction to innovation and next-generation products. Now, with the major expansion in the Canadian market as well as increasing global opportunities, we are well positioned to further grow the business and build the value of the company for the shareholders. Before we end today's call, I'd like to thank all the shareholders for their ongoing support at this exciting time in our evolution. With that, I'll ask the operator to close the line. With that, this is today's conference. Hi, Sarah.
Okay, that concludes the summary on Valens, the conference call. So yeah, it was very interesting. Just seems as though that they seem to have a moat within the company with their relationships with the bigger LPs. They don't want to really start an extraction facility themselves because there's zoning permits that aren't everywhere. So say Hexo's got their facility, they're not going to be able to get that bomb-proof zoning. So they like to just use Valens or Metafarm Labs. So that's a nice moat for them. And then they're also talking about the as cheaper biomass, and they're talking about their relationship with the brewery, the Iconic Brewing. There's beverages they're saying will be in the next couple of weeks, so that'll be good for them. And then they're also kind of just talking about their international plans. So yeah, thanks for watching, and everybody. I think this is going to end it off. Yeah, Shaka, peace. I'm out.